Welcome to the Business Concern Podcast. My name is Rick Rebusel, and I'm the Principal Consultant of Business Transition Consulting. My guest today is Patrick Ungashick, CEO of NAVIX Consultants, an exit planning consulting firm. The topic for today is exit planning for the private business owner. I'm a business consultant. My expertise is in helping private business owners document their planning. My blog is Owning a Business at owneragreement.com, and the Business Transition Consulting website is btcllc.net. My website on managing for value is priordiligence.com. I have two books available on Amazon. Now What? The Practical Guide for Getting Maximum Value for a Business, and Implementing the Buy-Sell Agreement, an introduction to the implementation process which creates wealth for you and your heirs. Welcome, Patrick, and thanks for being here.
Thanks, Rick. My pleasure to be with you today.
I want to start, Patrick, by mentioning two of your books, Dance in the End Zone and A Tale of Two Owners. I saw them on your website, and I just tell us a little bit about those books and how somebody could get a hold of them.
Sure. Thank you so much. So Dance in the End Zone is my first book. It's the general purpose book that I think all business owners should start with when they're thinking about and moving towards planning and preparing for exit. And then the second book is called A Tale of Two Owners. That book has won a couple awards, which I'm pleased to acknowledge. And that book is pretty specialized. We did some research a number of years ago, Rick, and learned that about 70% of privately held companies have more than one owner. And our national consulting practice has mirrored that. And as far as I know, as far as I knew when I wrote that book and still know today, there's really no specific guidance out there for business partners on how they should talk about exit and approach that issue. And as you know, because I know you're an expert on buy-sell agreements, that when you share ownership in a business with somebody, a lot of things change. So A Tale of Two Owners is just that. It's the book written for business partners on how to think about and get ready for exit. And both of them are available at Amazon and on a direct basis from our website.
No apologies to Charles Dickens, I assume.
None.
All right. Tell us a little bit about your background.
Sure, thanks. So after getting an undergraduate degree in political science, which meant I was not qualified to do a whole heck of a lot in the real world, I joined a firm in New York City. I was very lucky. I got to mentor underneath a pretty incredible investment banker and teacher. And I joined a very small investment banking team that was part of a large organization, couple hundred people inside the firm. But when I joined the investment banking operation, the headcount in that operation grew to 3. So it was small, but that's great when you're in the beginning of your career, because that means you get to do a little bit of everything and be in the room always and touch everything. So I spent about 6-8 years doing mid-market investment banking type services in New York before I moved to Atlanta, I guess almost 25 years ago now, which is still home for me today. And along the way, we just saw again and again some really great businesses founded by some really great owners that were struggling to exit, nearly universally struggling to exit. And that really shaped me and my career in trying to come up with a better solution for these very successful business owners.
Where'd you grow up? What's your hometown?
I grew up in a couple spots. I call St. Louis, Missouri, my hometown, because I lived there, through high school years, and I'm still a baseball Cardinals fan. I think they kind of imprint that on you when you grow up out that way. But I've lived in Atlanta now for a pretty good period of time.
Tell us a little bit about the Distinguished Clown Corps. I saw that online, and I know that's an impressive organization.
Well, it's my pleasure to be a part of it. The Atlanta Distinguished Clown Corps is a group of CEOs and other business leaders that we're full-time business leaders, but on a part-time basis. Specifically, the first Saturday in every December, we dress up as clowns. We spend some time visiting the kids in the Atlanta Children's Hospital, which is the largest pediatric hospital in the U.S. A pretty amazing organization, but pretty amazing kids too. Spent some time with them that day, and then march in the Christmas parade, which is why it's always the first Saturday in December, and then tailgate afterwards. So it's not hard work, but we get to clown around a bit, and we raise money for just a wonderful organization. So I tell everybody at absolute truth, Rick, it is my favorite day of the year, and it's a great organization.
I can imagine that's a great thing to do. I usually like to differentiate between private businesses and public businesses, and not
Absolutely.
everybody makes that differentiation or talks about it at the beginning. But if I understand you and some of the material I've read on your website, your interest is primarily with private businesses. Is that correct?
That's right. Right. Yeah, and they are incredibly different. I mean, people and whales are both mammals, but so we can trace a common lineage, but we're pretty different looking if you put us side by side. And publicly traded companies, it's a short but incredibly significant list of differences, not least of which is access to capital markets, which means that, I mean, if you get the CEO, if you read a news story or watch on on screen an interview of a CEO of a publicly traded company, rarely does he or she talk about exit strategies, because they don't have to worry about exit strategies. In most situations, there's a market readily available for smooth and efficient and immediate transfer of ownership of that company. Privately held businesses, as you know well, Rick, they don't have that ready market in nearly all situations. And so publicly traded companies need to worry about succession planning, and that's a very important topic for them. Privately held business owners need to worry about succession planning and exit planning. Very different mandate.
When you look at a private business, and my interest, and I gather you've dealt quite a bit with this phenomenon too, is that there's a big difference between a business with a single owner. Now, often that business has a single owner founder, and a business with multiple owners.
Yes.
The complexities increase with ownership.
Absolutely. Yes, and that's the reason why I ended up writing my second book, A Tale of Two Owners, because the issues completely change. And look, when you're 50-50 with another owner, or three owners, a third, you're all equal, at least in ownership, and so you probably approach strategic issues equally in terms of the shareholder percentage breakout, or the unit breakout if you're an LLC. But even if the situation is there's one majority owner, what we see a lot, Rick, is when there's one majority owner who owns 70, 80, 90% of the business, sure, that individual is in charge on things like who we're going to hire and fire and how money gets spent and so on, because they have majority ownership of the business. But even with majority ownership of the business, a minority owner can still block an exit, as you know well, unless there's a buy-sell agreement that has previously arranged mechanisms inside of it. Rick, if you and I are business partners together, like I said, unless we have an agreement that stipulates this, if you own 99% of the company and I own 1%, and you decide you want to sell one day, it's a free country. Nobody can make me sell my 1% interest in the business if I don't want to. And most buyers are not going to be interested in acquiring a company where 99%, where they can only buy 99%, and they get a 1% owner who may be disgruntled because he or she didn't want the deal to happen. So I know you can fill the time we have available talking about just buy-sell agreements, but that's just one example of where the ownership and the legal and the financial landscape is completely different as soon as you start to share ownership with one or more additional persons. That's just the legal side of it. Just one more point. Then there's the emotional and the relationship side of it. Most business partners like and respect one another. You don't make it very far in a business relationship unless you generally like and respect one another. And as a result, very few business partners, in my experience, are going to want to force an exit if it's running against the desires, the goals, the wishes of their business partner, regardless of the percentage of ownership. Most business partners are going to look to maintain some level of harmony within that relationship. And so, yeah, as soon as you're rowing down that stream and there's another person or multiple persons rowing in that boat with you, everything changes.
It almost sounds like it'd be a bad idea to have more than one owner.
Well, you know, uh, we do a weekly blog on our website, which is NAVIXConsultants.com. We've been doing it for about 4 years. And a top 10 article of ours, even though we wrote it several years ago, it still remains a top 10 read. I won't get the title exactly right, but it's something like 14 reasons to not share ownership with your key employees. There's a lot of them. And in our experience, we can talk about them, but I think one of the reasons there is a lot of ownership sharing that happens, the founder owns 100%, trying to attract maybe a key employee they want to hire away from a competitor, says, hey, in addition to paying you, I'll put 5 or 10% ownership on the table for you. We see a lot of that. And a lot of times business owners turn to equity as an incentive to hire someone or an incentive to keep somebody. We see a lot of that happening because business owners just don't realize that there are alternatives. You know, there are other ways to compensate and incentivize key employees, ways that look and act just like ownership without actually sharing ownership.
There's
Um,
something wonderful about being an employee instead of being an owner.
yes,
And if you can secure that valuable employee without making the employee an owner, there's a
right.
definite benefit.
Exactly right. And another quick observation is it's common with clients in the beginning of an engagement with a client, we scope out what's the client want to accomplish. And it's common that clients will say, hey, I've got these 2, 3, 4 key people that might want ownership. We've talked about it. We've sort of circled around the topic and I need to figure this out and address that. And great. And we'll put it on the to-do list. And eventually we'll spend some one-on-one time with those individuals, employees who maybe want ownership, seem to have expressed wanting ownership. And the most common outcome, Rick, is they don't want actual ownership. Because when we talk about buying into the company and writing a check, or even being bonused of the ownership and then having to pay taxes on that transaction, or signing on personal guarantees for the bank, right away, a lot of the enthusiasm around ownership wanes because those people don't want all the risks and responsibilities that come with ownership. They know they're valuable contributors to the organization and they want some economic upside. So if you can create that for them without actual ownership, that very often is a winning solution.
On the other hand, it's difficult for many in private business to find a buyer for the business. And many times the buyer is within the business.
Right.
So if that can be developed over time and be advantageous, and for the right reasons, then sometimes that's an advantage.
Absolutely. And you see that especially in a number of industries where there's a low barrier of entry, such as professional services firms, a lot of accounting firms and law firms and architectural and engineering firms and consulting practices. The buyer comes from within because that person is already part of the company and they want to continue it and they want to keep their job and preserve that career option for them. So very often in many industries, but especially in professional services firms, your best buyer works for you already.
When we deal with owner agreements and we try and get owners to come to agreement or talk about what they need to talk about to come to any kind of an understanding, one of the key things is to enable the owners to articulate their values, to
Mm-hmm.
really communicate together and find out where the variances are. And almost all the time, those values aren't the same as you've indicated.
Yes.
But understanding what they are and understanding that there is a way or there might be a way to work through all that is much better than ignoring it, or worse yet, assuming that those values are all the same.
That's right. And they're, as you just said, they're usually not. And that's another reason why I wrote that book, A Tale of Two Owners, because let's just create a scenario just for imagine this is Rick, you and I are business partners and we found a business together, 50-50 owners. On day one, we share one singular all-encompassing goal and value, and that is to launch and grow this company because there's really not much else to talk about or do in the very beginning. But as time goes on, simply because we are different people, differences are going to creep into the picture. You and I may be different ages. Maybe we have different levels of risk tolerance. We have different values on work-life balance. You know, maybe I've been married 3 times and have 9 kids and you've been married once and, you know, and so as you go through life, these differences develop. and they translate into different exit goals. And very often what I've observed happens is, as business partners, neither one of us has ever done this before. Most business owners exit only once, and we really don't know what conversations we're supposed to be having, and much less how to have them. And often these different values or priorities, they creep into the picture, if you will. And absent understanding what's going on and having a good set of tools for how to address these, very often we see business partners are waking up and they think that they're butting heads. They think they're having some, for the first time in maybe their long relationship, having some personality conflict. It's not that there's a lack of respect that's happened. What it is we're unintentionally, unknowingly rowing this boat in different directions. And you've got to figure out what that looks like, and you got to have a way to work through that because we're partners together.
In businesses which have been able to implement a effective planning process, what you've described is less of a problem. But I would guess, and I don't know an exact statistic, but let's just say most private businesses have not implemented an effective planning process, including owners not communicating their values to one another. So when you're presented with a private business with multiple owners and you see all those things manifested, what's your approach?
It starts with, I think you've touched upon this a couple times and you're exactly right. It starts with getting absolute clarity around goals and values. I mean, who's going to disagree with statements like, I want to exit happily, we want financially to get maximum value? That's great. But we got to put some specifics around that. What does maximum value mean? Let's measure and calculate that. Let's understand what, especially if there are partners, what does everybody need to walk away with a smile on their face from a financial standpoint? Again, most business leaders will readily agree with statements like, I want to make sure my people are treated fairly. What does fairly look like? Are we talking about writing big checks to employees as we walk out the door if the company is sold, for example? How do you treat different people, different employees? Do you treat them the same? Do you treat them differently? So you've got to get really clear around the goals and values. And then from there, you can explore the planning tactics and techniques that straddle business issues and legal issues and financial and tax issues that will pursue and hopefully eventually achieve those goals and those values. But you've got to start with goal clarity.
What I liked when I saw some of your material was this concept of transferable value.
Yes.
That's a valuable concept.
We talk about that a lot, and especially with owners of privately held companies. What's often a big aha moment for them is building a company for growth, pursuing growth, top line success, top line revenue, bottom line profits. That's not the same as creating value for a buyer or a successor. And even in very successful privately held companies, there are common examples of where, great, you're growing, but you're maybe not creating the value that you hope to. A couple very common examples is we call that one owner dependency. If that company is really unable to operate on a day-to-day basis and be profitable without the owner's direct, regular involvement, either because the owner has key customer relationships that flow through him or her, or the owner is one of the most talented practitioners inside that company, the best bottle washer in the bottle washing company. If that company is highly dependent on that owner, great, it might drive a lot of growth, but when you get to exit and that owner wants to move on and do something else, it's gonna be a big problem retaining those customers, delivering those products and services profitably, et cetera. So one powerful example of transferable value is owners have to build teams that can not just keep the company intact without him or her, but can actually grow the company without him or her. Otherwise, that value doesn't transfer to a buyer or successor. That's just one example. There's a whole bunch of others. Another common one is customer concentration. Again, companies can grow and be very profitable for a long period of time, having a large portion, 10, 20, 30, 40% or more of their revenue and profits coming from just a very small number of customers, one or two. But you contemplate standing on the 1 yard line, as I like to call it, thinking about, selling your business. Buyer is going to see that situation. Buyers are often going to see risk. They're going to say, hey, I don't know that I want to buy this company, or maybe I'm not going to pay as high of a price because the value that you're getting from that customer relationship may not transfer to us because as soon as you walk out the door, the customer's going to maybe say, I need to rethink my options in the marketplace. So yes, as an essential part of getting a company ready for exit is looking at how the company works across all of its operations and running it through that filter of that exercise that we call transferable value, and seeing where that value where it will transfer and seeing where it won't, and doing that early enough when you have time to make changes before you plan on exiting.
Woven through all that too is a psychological problem that someone who has successfully started or participated in to a significant extent their own business has a personal feeling about that business, and often it's conveyed. If you ask them who's your best employee, they'll tell you, well, I'm the best employee. I'm the best at everything. But the really effective owner, the owner that gets the maximum value for his or her business, is the owner that is relinquishing all the duties, is training, is establishing that business system that can run on its own feet without the owner participating or being the best employee. But the problem for the owner is much of the owner's self-image and personal idea of value is wedded to that business.
That's right.
And so at the same time, you say, well, you really shouldn't be the best employee. In a way, you're sort of demeaning that person's view of themselves.
I'm exactly correct. And that is, for a lot of owners, a big emotional leap to make. And some of them, a lot of them struggle to make it, and some of them maybe never make it. I mean, one of my favorite business books of all time is The E-Myth. There's a reason why it sold something like 10 or 20 million copies, because the story there from that book, as I'm sure you're aware, is you got to migrate from being the person who's really great at making pies, I think is the example from the book, to the person who designs and implements systems to make pies and hires people who follow those systems to make pies. And a lot of business owners maybe are not naturally adept at making that transition, or as you point out, Rick, maybe don't want to make that transition. But if you don't make that transition, then at some point in time, we're going to wake up one day, the business owner in that situation is going to wake up one day and realize, I don't know that I want to have to work 40, 60, 80 hours a week. I don't know that I'm comfortable with 80, 90% of my net worth tied up in this business. I've got other things that I might want to do with the next chapter in my life. But if that business owner is the best employee in the organization, then that owner may be trapped, and all the other people impacted by that business, all the other employees and all the other customers are trapped with him or her. So it is a huge issue, and one that involves deep emotions, understandably deep emotions, but owners got to figure it out. Otherwise, the outcome is usually not a very favorable or happy one.
I think the arrogant owner is a syndrome that is difficult to escape. The aspect of ownership and competency and success really makes it difficult sometimes for the talented and unique owner to become more modest about what needs to be done to really maximize the value of the business.
You're right. And undoubtedly there is pride in there. You're absolutely correct. And I'm the last person in the world who would point a finger at anyone else when the subject of ego comes up. I do think, however, very often when the business owner is, whether they're saying it out loud or not, feeling that they're the best employee in the organization at X, whatever X is, very often it's true. I mean, very often they really are the best at whatever that company does. A question that might help reframe, we see with working with clients, might help reframe the issue is, okay, great. So you've got a bottle washing company and you're the best bottle washer. All right, the people that you've hired and developed and trained, you've formally trained or they've learned from you over time. The question is this: they might not be better than you, but are they good enough? Are they good enough to do the job well for the customer? And what we often see is a business owner, when asked that question, will go, you know what? Yeah, they are good. Maybe not as good as me. Maybe they haven't done it as long as I've done it, but maybe they are good enough. And maybe just that reframing of the question can sometimes help business owners bridge that gap that maybe they're never going to be replaced by somebody who's better at bottle washing or whatever the company does than them, but is the team good enough to be able to do the job without them? And if the team is good enough, then maybe we can make some of that progress towards figuring out that a successful exit.
Some of the humility that you try to inspire can come from the idea too that although the founder or the business, the majority owner may be the most talented person in some arena,
Right.
when business conditions change, all of a sudden that arena may not be as important. It may be necessary to do a pivot. It may be necessary to go someplace else. And then that owner is going to need help. And if the people around the owner have not participated as a team, if they've not been part of the decision-making group, changing course can be incredibly difficult. And in fact, it might mean the termination of the business unless it can pivot, it can change, and you need that team to make that change.
Yeah, I mean, there's some great business leaders and thinkers out there who have pointed out that adaptability is arguably one of, and maybe even you could go so far as to say the most important characteristic of an organization, of a leader, of a leadership team, because change is constant. I mean, here we are right now dealing with an unprecedented public health and business environment. Here we are in May, and companies that cannot change, teams that cannot change, leaders, owners who cannot change, may not survive. So you're exactly correct in that observation, Rick.
You often hear when people list traits for leadership and business ownership, humility is at the top of the list, and I think that's the reason why.
Yes, I completely agree. Another favorite business author of mine is Patrick Ungashick, and he's well known for quoting that the characteristics that he wants to see in his organization and he recommends to other business leaders are hungry, humble, and smart. And I think if you have a team, if you have an individual that you can look at and say hungry, humble, and smart, you're going to probably be pretty successful in the long term.
Yeah, it's a difficult blend of psychology, statistics, perception of reality. The arena that you're in, exit planning, is part of the planning process that I think probably, because of the psychological element, is the most difficult. You see a lot of literature about starting businesses.
Sure.
You say when you're starting a business, it's pretty easy to focus. You just got to survive.
Sure. So my first book you asked me to mention earlier, Dance in the End Zone, I actually wrote it on a bit of a dare because at the time my business coach and mentor, I was sharing with him, this goes back about 10 years, so I'm sure my numbers are off. But at that time, I shared with him that I'd done a little research on Amazon. That's what, right? Research is going to Amazon. And at that time, there was something like 8,000 books available from Amazon. I suspect the number is bigger now about how to start a business. And I continued my research, and I learned that there were at that time, about 90,000 books that had something to do with how to lead and grow a business. And again, 10 years ago, there was something like 22 or 23 books on how to exit from a business. And, this is probably a little bit of an admission that maybe I shouldn't make, but I bought all 22, 23 of those books and I read them. And besides the fact there were very few of them, I didn't think that the quality was as comprehensive as it needed to be. And that's where at the time my business mentor dared me. He said, well, why don't you go write your own darn book? But I'm sure the numbers may have changed, but the ratio is probably the same. It's really easy to get started on a business. It's not difficult at all. It's really hard to grow one, and it's even harder to successfully exit from one.
Well, I think the whole reason to start a business, when you get right down to it, for most people, sure, we have lifestyle businesses where people want to be artists or musicians or craft things, and that's just what they want to do, and whatever they make, and that's fine. But setting that aside, if you're in business to make money, at the core of it all, is that at some point that business is going to make a lot of money for you and make you comfortable.
Right.
Uh, and I really like the concept that you bring out, which is the idea of personal financial freedom. Tell us a little bit about that.
Sure. Financial freedom has become a bit of a buzzword or phrase in the last 10 years or so. I mean, you go down to your local bank and walk in and grab one of their glossy brochures is probably going to talk about helping you achieve financial freedom. And I get it. That's, a pretty powerful phrase. Financial freedom for us has a very specific meaning, Rick, in that we define financial freedom as meaning that you've reached a point in life where you are working because you choose to, not because you have to. So work is a choice and not an economic necessity. Now, money does not buy happiness, and it absolutely doesn't. However, I will tell you, I'm around a lot of business owners and former business owners who have reached financial freedom, and they're typically smiling. So there's something going on in there on some level. In our experience, reaching financial freedom is almost always the number one goal of a business owner who's contemplating his or her exit. I mean, because if you don't reach financial freedom and exit, why exit? Just go back to work. And you'll notice that until right now, I've avoided the word retirement. A lot of business leaders do not wish for a life of pure retirement. They still see themselves doing something else, and that something else may create a paycheck, may create income, which is great. But there's a difference between doing something that creates a paycheck because you have to versus because you choose to. And so we know as part of the exit planning process that business owners have to define how much they need to reach financial freedom. And we call that exercise the exit magic number. And then you've got to look at what's the value in your business, and you've got to do the math and make sure the value that you have now and the value that you hope to create between now and exit, is that going to be sufficient, net of taxes, net of any other costs? And if you share the business, you got to divide the pie up by the proportions of the business that you own. You got to go through all that analysis and all that math and make sure that you're on track to hit your exit magic number. Because if you come up short, or if you're on pace to come up short, better do something different now so that when you get to your 1 yard line, you don't look around and go, I can't afford my own exit. That's not a position anybody wants to be in.
The other thing that's a little bit illusory about all this is that you see a lot of people saying, I'm going to think about that. Well, things have been going really well, and I'm going to, in a couple of years, I'm going to do something, and I'm going to create this situation. And as with many forms of planning, the procrastination continues until there's a realization that the value just isn't there for personal financial freedom, that you suddenly find that time isn't there either.
Right. Yeah. We're all human, and our own emotions can often lead us astray. I had a phone call just recently with a business owner, and it's a common type of phone call. But the numbers in this call were memorable. This business owner was telling me he was the sole owner of a company doing several $100 million in revenue with tens of millions of dollars of profits of EBITDA each year. Pipeline was he spent 5-10 minutes telling me with some pride and some humility. The team was amazing. The forecast, the business forecast environment looked incredible. Customers loved what they were doing. I mean, there could not be a more exciting success story. Yet everyone was telling him that he should exit, and he didn't want to go anywhere because of how fun they were much having. So I said to him, so let me get this straight. So you believe you will want to exit when profits are down and the pipeline is thin and morale sucks and it's not as much fun anymore and you're bored or you're stressed. That's when you will want to exit. Is that what I'm hearing? And, you could hear that pregnant pause on the other end of the phone line. And he said, good point. Right. Because at the time when the business is probably most ready is probably the time that anybody least wants to go anywhere because you're having so much fun and making so much money. And so our own emotions will get in the way. And that's another reason why it's really important to have a well thought out, objective, written exit plan that you're moving against so that you can mitigate against these swings in business results and performance, causing us to have, irrational feelings about timing and when we want to exit, and make sure we we exit at the right time, not at the wrong time.
Tell me about what I think is a great phrase, the rolling 10 years.
Rolling 10 years is something, Rick, that your listeners can test for themselves and or test on someone else's. When you ask a business owner, when do you want to exit? Just ask the question this way. Hey, ideally, when do you want to exit? Now, that's an open-ended question, and someone could answer that question using any methodology they want. When my kid graduates from college, when the stars are in a certain point in the sky, with few exceptions, the most common way business owners will answer that question is they'll express a number of years from now. Oh, I don't know, 5 to 10 years from now, 10 years from now. And the number 10 seems to be the most commonly cited number, either by itself or at the front or back end of a range. Here's what's really important about that is that imagine for a moment that you were to repeat that conversation 1 year later. The business owner who a year ago said, oh, I think I want to exit 5 to 10 years from now, is not going to say, oh, I think I'm going to exit 4 to 9 years from now. They're going to say 5 to 10 years again. And what we see is there is this phenomenon called this rolling 10 years that a lot of business leaders will spend maybe a couple decades telling themselves they want to exit sometime in the next 10 years or 5 to 10 years. And that's dangerous. And it's dangerous because we get lulled into a sense of feeling that time is rather infinite and I will always have enough time to get myself and my company ready. Well, what often happens is I spend a long time telling myself, I don't know, 5 to 10 years. And then I wake up one day and I realize it's not 5 to 10 years anymore. I'd like to get out of here in the next 2 or 3 at the longest. And you got a lot of work to do, and 2 or 3, which is 24 to 36 months, that might not be enough to get yourself and the company ready. So yeah, we call that, we observe that phenomenon over time, and we call it the rolling 10 years.
When you are working with a group of business owners and you ask them questions like that to try and draw out values and ideas about the business, also what you often hear is that there is a pause or a reflection, you can almost count the beat of the thought, yeah, I am having fun. This is a part of my life. This is really important. I'm going to miss this. I don't want to be without it. And at that time, I think it's important to go back and say, well, why am I doing this? What is the real purpose of all this? Yes, it's fun. It's satisfying. It's a productive activity. But I've created something that's going to perhaps give me some wealth, some personal financial freedom. Should I look past that for the immediate satisfaction that I'm successful now? Or should I get personal financial freedom and then see what else lies ahead? As you say, you certainly don't have to retire. If you've been a successful business person, you can do other things, some perhaps nonprofit, some profit.
Sure.
But your options are so much greater if you can see yourself apart from the business.
Yes. Absolutely. And eventually figure out what are you going to do in life after exit. This is why clearly I'm biased. I'm an exit planner. I lead an exit planning organization. But when you stop and think about it, practically everything that a business owner has accomplished and is probably rightly proud of is on the line when you get to that point where you're going to exit. Your personal financial wealth and balance sheet can go way up or way down depending upon how successfully you exit. The team that you have created, those employees, all those jobs that you've created, they can be upheld and continued forward, or they can be sacrificed depending upon how smoothly and how effectively that exit happens. The brand that you've created that probably has a great reputation in your industry, in your circle, the customers that you probably have, again, no small amount of appropriate pride in terms of the value that has been provided to those customers, and how your company has innovated its products and services. All of that either goes forward with dignity and accomplishment after exit, or it's at risk, and it often is failed or lost when an exit fails. So no matter how long that business owner has had a very successful career, 10, 20, 30 years or more, if it doesn't come together on the 1 yard line, and if there's not a successful exit, there's the real risk that the business owner walks away in life after exit with this disproportionately bad taste in his or her mouth because they did it right for all those other years, the first 29 years, but in the 30th year, for whatever reason, typically because of lack of planning and lack of appropriate steps and preparation, then some of it gets lost and left behind, which we very passionately want to make sure does not happen.
Well, let's return to our prototypical private business owner who's
Sure.
been hopefully listening to all this and has been motivated to get in touch with you or take a look at your website. Tell us a little bit about how that works.
Oh, sure. Thank you. So our company name is NAVIX, as in navigating towards your exit, NAVIX. And our website is NAVIX Consultants with an S on the end, NAVIXconsultants.com. And we do have a pretty extensive list of free educational materials for visitors to our website, business owners and their advisors. Most business owners are going to exit only one time and only have one shot at success. So we are very much in the business of educating people on the issues that are going to be coming their way and how to approach them. So there's videos and white papers and webinars and articles and tools. Probably the best one to start is a free ebook that we offer, Rick, called Your Last 5 Years, because there's something, I don't know, it is psychological, but there's something about once that business owner is telling himself or herself that they think they want to exit sometime in the next 5 years, maybe the rolling 10 has gotten down to the rolling 5. That's the time where you've really got to make this a priority. You've really got to get on top of clarifying your goals and your values and beginning to put in place and execute that plan. I mean, 5 years is 60 months. It flies by. So that may be, if someone has no other suggested starting point, that may be an ebook that people want to download from our site and start there, because it lays out everything that you're likely to encounter over your final 5 years and why it's so important.
The planning aspect is so important, and just getting people to do it is difficult.
Yeah, when I speak, I do a variety of workshops, and the three main workshops that I talk about, buy-sell agreements get a little bit of attention. I in a 2 or 3 hour workshop, they spend 5 minutes on them. I wish I could spend 55 minutes on them because so many people don't have them, get them wrong. The lawyer they worked with didn't really know what he or she was doing on that subject matter, or they even if it was a well done document, it's 10 years old. We see that all the time. And it doesn't even remotely reflect the current need or the current business landscape. So yeah, that is a huge, huge topic, and I applaud your content on it.
Well, thank you. I came into this because I was practicing law, and I saw exactly what you just described. It's just the implementation of the agreements, especially the legal documentation of the agreement, so often contributed to the problem rather than solved it.
Yeah,
that's sort of what got me into what I'm doing now.
yeah. Well, the issue that we encounter more than any other, because sometimes we can quibble with the language, and sometimes maybe it's not properly, covered by insurance and so on. But probably as exit planners, the number one issue that we see is we're working with a customer or prospect or client, and they say, oh yeah, we have multiple owners and we're planning on selling the business. And we pull out the buy-sell agreement, and the buy-sell agreement is silent on what happens when a buyer shows up.
Yeah.
It just says nothing. I say, great. You're covered if you die. That's not very likely to happen while you're an owner. And if someone gets really sick, that's fine. It's got the necessary provisions in there. But the most likely scenario and the most desirable scenario is you want to sell one day, and you got 7 owners, you got 2-3 main ones, and you got 4 of them that own 2% each, and a buyer comes along and there's no governance in there that says how the decision to sell is going to be made. Yep. And that's often a very unwelcome surprise, because they think that, majority rules applies here, and it doesn't.
But what I found is that before you can enter into any kind of an agreement, there has to be some sort of a planning environment and some sort of a decision-making group. And
Right.
once that's in place, then a lot of other problems can be addressed. But
That's right.
the one thing about a buy-sell agreement, and I can say this after dealing with completed ones for over 20 years as a lawyer, um, is that they almost never are followed. Whatever's in there is either so impractical or wrong that everyone just has to agree that they're going to do something else. But what I found is that if they actually got together and got the agreement done and had the discussions to do the agreement, they were capable then of
Right.
doing what they needed to do, even though the agreement. And then it occurred to me, well, even though I'm drafting these things, maybe the piece of paper and the words are not that important. Maybe it's the process. Maybe it's the idea that they can actually plan and make decisions together that really makes this thing work.
Yeah, I agree with that observation and I'm sure you've seen this with the caveat that they could have the discussions and they could follow the process before when there was no external threat, right?
Right.
No one was sick, no one had just died, no one was going through a messy divorce, no buyer was standing in their doorway with a checkbook in hand. Because if they wait too long, and you are exactly right, very often the document is not followed, certainly not exactly to the letter when a triggering event happens. But when someone did just die, or there is a buyer standing in the doorway with a checkbook in hand, now with that external pressure, if they're that can reveal if they don't have the kind of relationship or maturity or trust to be able to handle that issue without an agreement to fall back on, they may be in trouble.
My new concept, well, within the last year or so, is the idea of a dynamic planning document, a document that is amended as it needs to be and documented as it's amended, so that planning is not done at retreats, planning is not done occasionally, planning is done every day when you make a decision. And when you make the decision, you make it as part of the decision-making process and document it as part of that process. And I haven't really espoused this to too many people, but in my view, that's the legal document as well. So once you get to the point where you have planning implemented in the business, once you get to the point where you are able to plan dynamically, revise your goals as you're making your decisions, and accomplish the documentation as you're doing it, you're really writing and rewriting the owner agreement as you're doing that.
Right.
And I find that to be a pretty exciting concept, but you can't get out there with people that aren't used to thinking about it. They hear the theme from the Twilight Zone or some science fiction theme, but I do believe that that's where we're going with truly competent business ownership, is that you're going to have a decision-making group that documents its decision, and those things that they approach and do will become the agreement between them. I want to thank you for joining us today. I've enjoyed it, and I'm sure that our listeners appreciate your knowledge and enthusiasm for what you do. And I will say from personal observation that you do have an excellent website. It's very informative.
Thank you.
And I enjoyed looking through it. So I want to end by mentioning that my website, businessconcern.net, is where we park the podcast, but the podcast is distributed on the standard podcast outlets, so it'll be available on iTunes and some of the others for downloading or whatever. So I thoroughly enjoyed having you today, and we look forward to maybe running into you in the future if that occurs. But I appreciate it.
Thanks,
And,
Rick. My pleasure. Absolutely.
Thanks everybody for listening.
Take care.